Welcome to my channel, my friends. Today I want to tell you an exciting story that could change the way you think about life, money and success. What I'm about to share with you isn't just a story. It's a lesson that has transformed millions of lives. We're talking about Rich Dad Poor Dad. One of the most powerful books even written on how to achieve financial freedom. Let's start the summary of this story. Rich Dad Poor Dad, first published in 1997, has sold over 32 million copies in more than 51 languages. Endorsed by celebrities such as Oprah Winfrey, the book remained on the New York Times bestsellers list for 6 years. This concise summary of Rich Dad Poor Dad outlines 6 rules the authors believe will help you make your money work for you, rather than you working for money. It also highlights some of the illustrative stories shared by the authors to explain these 6 principles. Poor Dad versus Rich Dad. The love of money is the root of all evil, versus the lack of money is the root of all evil. I cannot afford it, versus how can I afford it? Money doesn't matter, versus money is power. Study hard to get a good job, versus study hard to buy a good company. One was my poor dad, the other my rich dad. How did I end up with 2 fathers? One was my biological dad, who worked diligently throughout his life, provided a comfortable living, but rarely had much left after paying the bills. The other was my best friend Mike's father, who had fewer academic qualifications than my biological dad but earned significantly more money. As a child, when I was told I should make money, I teamed up with Mike to take the phrase literally. We decided to melt down empty toothpaste tubes and turn them into our version of nickels. When this plan inevitably failed, we turned to Mike's dad, who promised to teach us how to make money, not through traditional lessons, but in a hands-on, practical way. Rule 1: The rich don't work for money. At Mike's dad's suggestion, we started assisting at his office, running errands for a small wage, just enough for us as 9-year-olds to buy some comic books. Before long, I became frustrated and boldly announced that I was quitting my job. When Mike's dad spoke with me, I complained that he was exploiting us kids. That's when he shared his first lesson with me: the poor work for money. The rich make money work for them. Most people work for a monthly salary. They labor diligently, hoping for a raise, paying bills, and blaming external factors, like their boss or circumstances, for their financial struggles. But the truth is, the root of the problem often lies within us. The change needs to begin with ourselves, not the people or systems around us. When a salary becomes the center of our lives, we fall into the pattern of working for money rather than having money work for us. The key is recognizing this choice: to work for money or to let money work for you. The trap of working for money. Those who work for money often find themselves caught in a cycle they're unaware of, a trap. It consists of working hard, earning a paycheck, dreaming of vacations, juggling bill payments, clinging to the illusion of job security, and eventually, waiting for retirement. Fear and greed feed the cycle. This trap is fueled by fear and greed. The fear of losing our jobs pushes us into the rat race, while the desire for more possessions keeps us running within it. This endless loop becomes our reality. The fear of losing our source of income makes us feel insecure, allowing money, or the lack of it, to dictate our emotions and decisions. Yet, it's crucial to ask whether a job is truly the best way to create long-term financial security. Often, the answer is no. A job is merely a short-term solution to a long-term problem. Breaking free. The way out of this fear and greed cycle is to take control of our thoughts. By choosing how we think, we stop reacting purely to emotions. Instead of asking, "I deserve this raise," we ask, "What am I missing here?" I embraced this lesson, and Mike and I started a comic book library. Although it only lasted 3 months, it taught us invaluable lessons. For the first time, we weren't employees, we were in charge of our finances. Even more importantly, the comic book library generated income for us even when we weren't there. Our money was working for us. Rule 2: Financial literacy is essential. In 1994, I retired at 47 years old, with my money working for me. By that time, Mike had taken over his dad's business and grown it exponentially. Both of us achieved our success thanks to the financial literacy lessons taught by Mike's dad, my rich dad. The core of financial literacy, as Rich Dad emphasized, revolves around one key principle: understand the difference between an asset and a liability. Many people believe they know the distinction, but in reality, they often mistake liabilities for assets. Simply put, assets put money into your pocket, while liabilities take money out. Professional success versus financial literacy. You may excel in your career and earn a high income, but that doesn't necessarily make you financially literate. Your house an asset or a liability? Financial literacy isn't just about earning money, it's about knowing how to spend it wisely. For example, many people consider their homes to be assets. However, if you take a closer look, a house is often a liability. While owning a home may offer tax breaks, it also comes with significant expenses. Most homes are purchased with 20 to 30-year mortgages, which means the house is a liability until the mortgage is fully paid off. Assuming a house is an asset without considering its financial implications can delay your financial education. This isn't to dismiss the emotional satisfaction of owning a home, but the priority should be to build income-generating assets first. The income from these assets can then fund the purchase of a home. When salaries increase, the extra money should be invested in assets rather than spent on liabilities, such as a bigger house. The wealth mindset. The rich buy assets. The poor incur expenses. The middle class buys liabilities, believing they are assets. By understanding and applying this principle, you can start building true financial stability. Rule 3: Mind your own business. If you were asked about the business of McDonald's, you would likely respond with fast food or burgers. However, Ray Kroc, the founder of McDonald's, viewed the company differently. He believed that McDonald's was in the business of real estate. The key to McDonald's success was its location, the land on which its restaurants were built. This story from Mike's dad became our third lesson: mind your own business. It's crucial to understand the distinction between your profession and your business. Many people use these terms interchangeably. For Ray Kroc, his profession was selling franchises to make burgers, but his true business was acquiring income-generating real estate. As professionals, we often end up minding someone else's business. We work for a salary, which becomes our income. However, as business owners, we should focus on using our income to acquire assets that generate revenue. Assets versus liabilities. Common assets like a mortgaged home or a car purchased with a loan can become liabilities if we lose our jobs due to downsizing or restructuring. Minding your own business means investing in revenue-generating assets rather than liabilities or luxury items. These assets can include stocks, bonds, mutual funds, real estate that generates net positive income after mortgage costs, or anything else that produces ongoing income. By focusing on building such assets, you take control of your financial future, rather than relying solely on your job. Rule 4: Use the cover of a corporation. The origins of taxation can be traced back to Britain, and unlike many other British practices, the US adopted permanent taxation with the 16th Amendment. Today, taxes have divided us into two groups, the haves and the have-nots. The have-nots often embrace the Robin Hood mentality of taking from the rich. Ironically, it's the have-nots who end up losing the tax battle. When you work in a job and earn a salary, you allow the government to tax you more. However, the haves approach taxation differently. They run their own businesses, which brings tax advantages that employees don't benefit from. In contrast, employees are taxed as soon as their salaries are paid, long before they even see the money in their bank accounts. What is financial IQ? To navigate taxes effectively, it's crucial to build financial IQ. Financial IQ involves 4 key actions. Understand accounting basics. If you plan to run your own business or already do, it's essential to understand accounting. This allows you to read and interpret financial statements, which is a key skill in managing your business and taxes effectively. 2. Understand the science of making money or investing. It's important to grasp how money is made and how investments work. This knowledge helps you grow your wealth and make strategic financial decisions. 3. Understand the demand and supply aspects of financial markets. Having insight into how financial markets operate, through the principles of demand and supply, allows you to better navigate investment opportunities and risks. 4. Understand the law, especially how income is defined for individuals versus corporations. Understanding how the law differentiates between individual income and corporate income is vital. Corporations often enjoy tax advantages that individuals do not, so knowing these legal distinctions is key to optimizing your financial strategy. When you work for someone, you earn income, pay taxes on it, and spend what's left. However, when you manage your own business, the sequence changes: you earn, spend, and only then pay taxes, allowing you to retain more control over your finances. Rule 5. The rich invent money. When Alexander Graham Bell patented his invention, the telephone, he approached the largest corporation of the time, Western Union, offering to sell them his patent and company for $100,000. Western Union rejected the offer. Bell went on to build an industry worth billions, with AT&T at the forefront. Much like Bell, we all have an inner critic that causes self-doubt and might lead us to seek approval from others, just as Bell did with Western Union. But there is also a brave hero within each of us, willing to take risks and create something extraordinary. It was likely this brave hero inside Bell that allowed him to overcome the rejection and ultimately create immense wealth with his telephone invention. Information is wealth. We live in remarkable times. A few centuries ago, land was considered the key to wealth, but today, information holds that title. Wealth is no longer bound by geographic limitations. Opportunities are abundant, and now is the perfect time to sharpen our financial intelligence. So, how can we enhance our financial IQ? The first lesson in financial intelligence is understanding that money itself isn't real. The true wealth is in our minds. Great opportunities arise from a well-trained mind. When the mind is properly trained, it can spot opportunities that others may overlook, which can later be turned into money. Once we realize that the real money lies in developing our financial intelligence, we become more willing to take risks and invest in opportunities that others fail to recognize. Rule 6. Work to learn. A business consultant once told me, "You are just one skill away from great wealth." This statement means that our income can increase significantly by mastering just one additional skill. Earlier in this summary, we discussed how financial IQ is a combination of accounting, investing, market understanding, and knowledge of the law. Yet, many people believe the key to making money is simply to work hard. For most of us, combining working hard with the skill of financial IQ would cause our income to grow exponentially. While my poor dad encouraged me to specialize in one field through study, my rich dad advised me to know a little about a lot. It's important to understand that learning doesn't always align with job security. Education is the best investment. You can only learn so much if you remain in the same job for years. Getting attached to job security is a poor long-term strategy. While it may be effective in the short term, it's better to focus on learning more, rather than just earning more. Education, in the long run, is more valuable than money. Key management skills for success include cash flow management, time management, and people management. Additionally, communication and sales skills are core to achieving success in life. Why do the financially literate struggle? Even if you're financially literate, you might still face challenges in building revenue-generating assets. Here are some common reasons. Fear of losing money. Having a fear of losing money is natural and exists in all of us. What matters is how we handle this fear. If we respond by playing it safe, we start fearing failure, which becomes a bigger issue than the fear of losing money itself. The inability to take risks keeps us from seizing opportunities to grow our assets. Deep-rooted cynicism. Our inner critic can either help or harm us. When self-doubt dominates, every plan becomes riddled with worst-case scenarios. Listening to these negative thoughts more and more can prevent us from seizing valuable opportunities. Laziness. Are you too busy to focus on your wealth? This isn't about being busy, it's about avoiding things you don't want to face. To overcome laziness, you need a bit of greed. Healthy greed can drive you to ask for more and take action. However, excessive greed can lead you astray. Bad habits. Good habits are difficult to form, but bad habits face no resistance. Prioritize your financial literacy. Don't be the first to pay bills, that's a bad habit because it places others before yourself. Don't let landlords or bill collectors push you around. Arrogance. Arrogance occurs when ignorance and ego combine. It's a dangerous combination. Avoid using shortcuts to cover your lack of knowledge. Instead, focus on educating yourself. Go ahead, and take action. To make your money work for you, take action. Look for new ideas and find mentors who can teach you something new. For instance, read Peter Lynch's Beating the Street to understand stock picking. When the stock market crashes, don't retreat, dive in and start buying. Money is not real, it's an illusion, an idea. The science of making money lies in thinking differently and recognizing opportunities to build revenue-generating assets. Think and Grow Rich is a well-known book, and there's a reason it's not titled Work Hard and Grow Rich. Developing a strong financial IQ will shift your focus from generic advice like work hard to leveraging insights that will improve your financial literacy and build wealth. Start now, as action always beats inaction. As you finish this story, keep in mind, your path to financial freedom starts today. Begin with small steps. Stay persistent. Embrace the lessons from your failures. Dream boldly. And never, under any circumstances, give up. The only barrier to your success is the one you create for yourself. The world is full of opportunities, ready for you to take that first step. This is your moment, make it worthwhile.